Pat, you are a Marshall Reddick legend.
Marshall's got something special going on here, and you need an internship. You should go there and see if you can get a job. I showed up, and Marshall gave me the job. I started the next day. Ross, we have a love-hate relationship, and I want to beat you in pickleball more than anything in the world. I just need a little bit more practice.
Yeah, I think that as a leader, you need everyone to be on the drop of a dime, understanding the mission, vision, and values of a company. Personally, very grateful that we went through that because it really benefited us, and I think will have been a pivotal turning point in our lives that, you know, financially it's changed our lives forever. Pat, you are a Marshall Reddick legend. How did you get started at Marshall Reddick?
I was an intern in 2003, if you can believe that.
Oh, wow.
It's been more than 20 years now. And, you know, my parents were investing with Marshall Reddick in the late 90s. And I was going to school in Los Angeles. I needed an internship, and my mother was on me, man. She really, really was like, hey, Marshall's got something special going on here, and you need an internship. You should go there and see if you can get a job. I got annoyed, and finally I said, okay. I showed up, and Marshall gave me the job. I started the next day.
How did your mom know Marshall?
You know, I'm not sure. Maybe it was a friend that like referred her to like the types of meetings that he was having back then. And, you know, they started kind of exploring real estate and investing with him. They bought a few single family homes. So, you know, I think that's really how she got involved.
That's incredible. So 2003. So a little bit's changed. There's the internet now.
Yeah, technology has changed a lot. I have this photo from back then as an internship and the size of the monitor that I had sitting on my desk. I mean, I don't even think I could like lift it or move it by myself. There had to be two of us to do it.
Oh my gosh, that's crazy.
Yeah, we didn't have any laptops. They were all desktops at that time. I'm sure maybe laptops existed, but Marshall really wasn't a technology adopter.
Yeah. And then how did you get into private lending and the hard money loan space?
Sure. You know, the first like 6 or 7 years of my career after starting with the internship was really kind of learning the business. I was on the accounting and the finance side. And it wasn't until the recession, 2007, 8, 9-ish, and really seeing the destruction that happened. But our private lending program was born out of that time. Banks were illiquid. Really tough to get a loan. And we knew people, you know, given the history and time that I'd spent at Marshall Reddick, we knew folks, small real estate brokerages, property management firms spread around the country. And there was a couple of guys, one in Ohio, one in Georgia, one in Tennessee, that approached and said, hey, there's all this distressed property out here, foreclosure, short sales, you name it. And they needed more money. So they were like, hey, you know, we know that you and the Marshall Reddick team know people, California, and how can we tap into that? How can we bring this together? They've got the money, we've got the deals. Marshall Reddick needs to put that together.
Yeah, well, and that was also an interesting time because the liquidity of banks had just locked up and you could not get loans for, like 4 years, really.
Yeah, it was a while. I think that's really when hard money became more than just like a localized mom and pop type operation. Yeah. And certainly we learned a ton during that period of time and understanding like the nuances of a real estate transaction.
Yeah, what year did you start losing to me at pickleball?
Well, that's a sore subject, to be honest. You know, Ross, we have a love-hate relationship, and I want to beat you in pickleball more than anything in the world. I just need a little bit more practice.
Yeah. So
one of these days.
I know, one of these days. Pat and I, in the early days, when we were a lot smaller, we shared an office for like 3 years, and probably
What do we have, about 10 people working for us at that time?
Yeah, I think, and the whole company was 10 people. And we were in this tiny little office, and Pat and I shared probably the two loudest people in the world with very big opinions. Those were good days.
A lot of arguments going on right there.
Absolutely.
I'm sure the other staff got used to us bickering and so on.
Yeah, absolutely.
Those were really good times, though. You know, working through the 2008 up until 2014.
Yeah.
You know, when we were able to purchase the business from Marshall Reddick, and the guy, he actually retired and moved on. and then bringing in all the different services that we now offer today, as opposed to being really more of like a referral network.
Yep.
Getting into the brokerage, the property management. It was initially the private lending.
Yeah.
And I think we had some success there.
Yeah.
That got us some capital going so that we could start opening up our own offices starting in Texas.
Yep, absolutely. You know, it's crazy to think about like the last 10 years, you know, raising over $100 million. I mean, had you told me that in, you know, 2014, 2015, I'd be like,
yeah, I never would have believed
I don't even know 100 people with money. So it's pretty incredible. What I'm curious from your perspective, like, what do you think attributed that? Like, how did we raise over $100 million this last, you know, 10 years?
Relationships is huge.
Yeah.
You know, you got to get to know people. You want people to get to know you.
Yep.
We're just normal people like everybody else.
Yeah.
But we work really hard. We communicate well. You know, we're going to answer the phone. Absolutely.
Answer the phones.
We're going to be responsive. You know, we're going to work really hard. We understand we have the privilege to work with people's savings and working with their money, and that's really important.
Yeah.
So I think that we're going to continue to do that, and you know, we're going to be that person that you can trust.
Yeah. I want to talk about the early days for a minute, because I think a lot of people, you know, I think we came about private lending and hard money lending in a very unconventional manner. You know, we did not have wealth, we didn't have experience, and so I want you to explain like the differences of investing in individual mortgage versus, you know, now we obviously have the mortgage fund, and talking through how that transition occurred and how we're raising capital in the early days to how we're raising capital today.
Yeah, the first 10 years of our lending business, so 2010 to 2020, we funded all of our loans, about 3,000 loans in that period of time. And we did it all with individual trust deed, mortgage, or note investors, whatever you want to call it. So one lender on one loan.
Yeah.
And we got really good at that, but it's very difficult to source the capital, especially with higher loan amounts in a very short period of time.
Yeah.
I mean, we're getting approached and the borrower's got a great transaction. We're talking about they need to close in 7 or 10 days.
Yeah.
So everything from loan application to underwriting, escrow, title, insurance, and then sourcing the capital and bringing the transaction together. You know, we got really good at that, but we realized probably 2017, 18 or so that we were missing on higher loan amounts, maybe a little bit longer terms. Each direct lender has their own, you know, how they look at things.
Yeah.
And so with the fund, right, it opened up this whole different aspect. And I think a lot of capital partners like that as well.
Yeah.
It gives diversity. You know what I mean? So you can invest in this pool and we manage and control the capital as opposed to being an individual note holder on like one transaction. The risk there, I think, is way greater. You don't have the diversity in that type of situation.
Talk through, you know, everybody always hears like, you know, trust deed investing or mortgage investing. And I think people think that's different, or note investing. Like, talk through the literal meaning of those different things and kind of explain a little deeper, like what actually is a trust deed versus what is a mortgage or what is a note.
Well, in lending, there's some primary documents. So the mortgage or the trust deed, those are basically synonymous. It's just a state thing. So California, for example, is a deed of trust state, where Indiana is a mortgage state. But nonetheless, that's the document that gets recorded in the county that perfects the lien against the property. That's the security for the lender. Whereas the note, there's certainly a note as a part of every loan transaction as well. And that documents, you know, the term of the loan, the interest rates, who the borrower is, who the lender is, that type of thing. So to get to your back end of that question, you know, being a mortgage or a trust deed or a note investor really mean the same thing. But there is two nuances there. And mostly what we do is we're bringing the origination together. Okay, so we're originating and funding a new loan. We are not selling closed loans, which I think in the industry, when you talk about being a note investor, a lot of times the originator is closing that loan and then selling that note or that security in the secondary market.
Well, I think too, there's also this perception of like, I'm a note investor because I met a fix and flipper at a networking event or whatever online, some, social media influencer or whatever. And they start lending to the flipper directly.
Fastest way to lose money.
Oh, well, my favorite thing is we've met people that literally don't have a recorded deed or don't have a mortgage. Like they truly are just buying or lending the note unsecured, which is insane because they think they have a mortgage because they have a 4-page document that gives a loan term. It's insane.
Don't quit your day job.
Yeah.
Work with a professional. We have learned a ton over the years, and I'm really thankful for those opportunities.
Yeah.
And, I like to take that knowledge and that education that I have learned and provide my clients with just amazing service.
Well, I think what's cool about us is that we kept our roots of investors having the ability to invest directly in an individual mortgage when we added on the mortgage fund.
Yeah, we do both today. There are those engineer types, and they want to tinker and they want to learn and they want to read that paperwork and they want to understand that.
Yeah.
So that makes sense. And I think that the direct lenders, the individual note investors, they serve a great role in our business.
Yeah.
And we're happy to run both programs simultaneous, right side by side. There's plenty of deals to go around for both. And oftentimes we find people that go mortgage fund, then want to go note individual direct lending, or vice versa, where they start in the individual loans and then they end up going to the mortgage fund, or do a combination of both.
Yeah. I want a fun story. It can be an investor. It can be an investor story, or it can be a borrower story. Obviously, when you're doing thousands of loans and hundreds of millions of dollars, like there's just always good stories. Just give me a good borrower story.
Oh my gosh, I don't even know how to answer that question. Is this going to be a John Krenya question?
Oh man. I mean, in the early days, what's the smallest loan amounts we were doing?
In 2010, we did 4 loans. Each of them were for $25,000 against property that was probably being purchased between like $8,000 and $10,000. I mean, it was such a unique situation with that nosedive of real estate.
Yeah.
And those were the good old days.
Yeah. Yeah. I think a big learning experience for us was the loan we did in Indianapolis. I think it was Mark Moss on the deal. It was that large triplex. I think in was it Midtown or? It was
close to downtown.
Yeah, it was a very trendy area.
Yeah, it was a 4-plex. It's a really unique, it's pretty awesome property.
Yeah, that was, we'll walk through that. Some of the learning experiences in that with the borrower and, how we did construction draws back then to how we do construction draws today.
Oh my gosh. Our program has just improved 1,000%. I think for me, trust but verify is always something that you need to have in the back of your mind.
Yeah.
And you can't get emotionally or financially involved really with either client, but specifically the borrower client.
Yeah.
And the background that I come from, I'm very trustworthy. I'm from California, lived in California my whole life, and going out to Indianapolis when we got into trouble on that loan and kind of seeing what other states and cities can look like.
Yeah.
I mean, the location of this property is pretty good, but some of the areas I toured of Indianapolis were, worse than I could have ever imagined.
Yeah.
And I realized at that point in time that the borrower on that transaction, he wasn't actually going into those areas and he wasn't verifying the work getting done by the contractors and things. And that rolled up to us. And, we could have had more oversight on that. To speak to the construction draws, we do things much differently than we did then. A lot of times it was really trusting the borrower, and the transactions were working and they were getting them sold. And, I think that borrowers and their accounting could be much better.
Yeah.
And so when you give a construction draw, it's like, is that money actually going into that asset? As opposed to the other 9
flips they have going on.
Exactly. And so with this one specifically, it took a while, but we caught on that the borrower, had some projects that were over budget, and
Yeah.
some of those draws were getting into those other properties. And then we ended up exhausting all of the construction money that we had, and the project was incomplete.
Yeah.
And at that point in time, we went out there. I went with Mark, and we just said, we've got to take back all 10 of these projects that we had at the time. And boy, that was a learning experience, and working through that from a legal perspective.
Yep.
And again, those experiences and losing money, I think, really helps you become a better money manager, and approach all of your future projects with that experience in a much safer manner.
Yeah. So now we are moving from a Reg D 506C to a audited REIT. That's
It's going to be a game changer.
Yeah, absolutely. What are some of the benefits of that, and what does that transition look like?
Well, it's underway already. We're going to have an audit coming up here pretty soon. That has been a huge learning experience, working with the CPA firm, and exactly how to look at that. Something I think I've learned about the audit is that it's not necessarily your financials, but it's a deep dive on your portfolio.
Yeah.
For us, we're debt, we only make loans. We don't own any real estate, but they really want to look at the granular level of what your portfolio looks like, loan to values, valuation, things of that nature.
Yeah.
Where I used to think it was just, only accounting 101 type of situation. So that's going to be fun. And, I think that really goes with our desire for transparency. As far as the REIT goes, that's just a big tax savings, I think, is number one. I think there's a 20% QBI deduction that is going to be eligible for all investors. So I think bigger investors really are focused not only on return, but how to keep the money that you earn, as opposed to giving it to the government.
Well, it's going to add an extra 1% essentially effective return on investment to the total return with that lack of tax needing to be paid.
Absolutely. So in addition to the tax perspective with the REIT, there are some other underlying benefits, specifically as it relates to our fund and our business. We work with a lot of self-directed retirement account lenders. So there's about 100 of those folks invested in our fund now, and we're unlevered. But nonetheless, if you bring on leverage, it could create a taxable situation for those otherwise tax-free or tax-deferred retirement accounts. And so the REIT, it functions as a blocker. So in the event we wanted to bring on leverage at some point to enhance the returns, we'd be able to do that without affecting that large group of self-directed retirement account lenders that we work with.
Yeah. And I mean, how much capital do we have today, and what are we looking like over the next 5 years?
Sure, we're managing around 125 million today. About 40% of that is in the hands of the direct lenders on individual transactions. 75 or so is in Marshall Reddick Mortgage Fund. And that is currently all lent out. There's about 675 loans in our pipeline right now, all with the individual borrower, all with an individual lender. And, we committed initially with this fund when we launched it in 2020 to raising 100 million. So we're getting close. It's just been a really slow, methodical march, about 1 to 2 million a month or so. But I think bringing on the REIT, have it in the audited financials, the sky's the limit. We just need to be able to make sure that we can keep the capital working, avoid cash drag, and not be forced or pressured into making loans that we otherwise wouldn't. We need to make good decisions, good collateral properties with good loan to values.
I love that you say 1 to 2 million in additional capital a month. It's just,
people love what we're doing.
Totally, it's so cool to see. It is so cool to see. Tell me about the differences. So there's pros and cons to everything, right? And if I'm an investor and I'm hearing, the mortgage fund is better, or this individual mortgage is better, there's pros and cons to everything. So walk me through, as an investor, what the pros and cons are to investing in an individual mortgage versus investing in the mortgage fund.
Yeah, that's a really good question. So when it comes to investing in the individual mortgage, I think primarily people look at that initially because the note rate is going to be higher than, compared to the mortgage fund return. But that's that's not 100% true. But again, the primary reason is folks want to get, and when you look at both of them, they think they're going to earn a higher return. So they want to go there. But it's active. Being an individual note investor is not super passive.
Well, the return on investment for a mortgage is only during the life of the mortgage.
Yeah.
So if you're making 12% return and you're only making it for 9 months a year, you're not actually making a 12% annual return.
Yeah, 9%.
Yeah, there's three months of inactivity. There's 3 months of capital not being at work.
Totally. And the individual lenders don't quantify the cash drag that goes into that, right? They have family, they work, they want to go on vacation. And so it's great, as you said, to be earning 10 or 12% while you're invested.
Yeah.
But then when you get your cash back, now it's like, well, if you don't hustle and work with Marshall Reddick to redeploy into the next loan, like you're bringing that average annual return down every day that goes by.
Yeah, so I would definitely agree with that. What about the mortgage fund? So what do those returns look like?
8.5% since inception. That's with returns reinvested.
Yeah.
But to really understand that question, you have to understand that we have a few different tiers or classes.
Yeah.
And we love all of our capital partners, but we are willing to give a little bit more from the management side to those with higher capital balances.
Yeah.
So about 0.5% higher for the second tier, which is for capital accounts above $500,000. They're earning about 9%. And then for $3 million and above, which is our highest tier, those folks are earning about 9.5%.
Yeah. Yeah.
When it comes to the mortgage fund, though, to me, that's truly passive. Right? You believe in the model. You believe in the diversification.
Yeah.
You know that we're lending in first lien position only.
Yep.
Right? So the risk of loss is so low, especially with the diversity that 275 loans in our portfolio today, what that offers. So it's extremely passive. And I think, again, the risks of having it more in like a pooled style.
Yeah.
So I think that the lower risk there, and especially like we're going to have defaults. Defaults are a part of lending money.
Yeah.
But in the fund, we're going to manage that default. We're going to find the best way to dispose of the asset as quickly as possible.
Yeah.
Whereas if you're on the direct lending side and you catch one of those defaults, like we're going to work with you and we're going to help you out, but it's your money in that loan.
You own the loan.
You have got to make the decisions. You are financially involved. And that could be like a 6 or 12-month period of time where you lose the cash flow and you've got to make some advances.
You even need to advance capital, whether that's finishing
Insurance,
the
property
renovation,
taxes.
Filing for foreclosure, hiring the attorney.
Yeah, and I think it's important to quantify, though, if we're lending at good loan to values, defaults can be uncomfortable, but they don't actually mean loss.
Yes.
It's the period of time where you've got to make those decisions and you maybe have to put out capital that you weren't expecting to do so.
Yep.
So, again, pros and cons to both. I've done more direct loans than I think any investor on our platform. I've certainly got a big position in our mortgage fund like you do.
Yeah.
I like both, but I think as I've gotten older and I understand a little bit more, and from my experience, the mortgage fund for me is the way to go.
Yeah, I think as I get older, you got the wife and the kids and life. You want to occasionally go on a vacation.
Absolutely.
And, you got to get your workouts in. It's like happiness comes from simplification. And you realize like the more investments, the more assets, the more toys, like equal less happiness because it takes more time and all you want to do is chill.
Absolutely. I think too, something really important that I've learned is not chasing high returns.
Yeah.
I mean, I work so hard to save, to invest, to build wealth, and I don't want to use the word gamble necessarily,
but
I would just take a much lower return and never lose money as compared to chasing double-digit returns and doing things that potentially could translate into loss. So I don't know, that's a perspective that I've gained over the last 15 years.
But I think that comes from doing it. Yeah. Like we've made some out of the park grand slam investments, and we've also made investments where we've lost money. And when you factor in the pros and cons of that, I think as you get more capital, you're more about just capital preservation and growing it at a healthy rate where it's not going to go to zero, and it's just going to tick up every quarter.
Absolutely, yeah. Stay diversified.
Stay diversified. That's
Stay
right.
safe.
Yeah, exactly.
Protect what you have.
I know. Oh my gosh, yes. What about time commitment? I mean, if you take ownership of this mortgage, like what does that look like? And, you know, do you foreclose on the house? Do you keep the house? Do you now have a rental? Do you sell the house? Like what does that look like?
Yeah, as a lender, there's a very specific path in the event of default, and we try to avoid foreclosure at all costs. Okay, but that is the process, right? If you have a default and your borrower is not responsive, they're not making their payments or property taxes or insurance or something of that nature, then you do need to get state-specific counsel. So if the property is in Florida, we're going to get a Florida attorney. You know, we only lend in areas where we have a footprint, so we're going to have those connections. And each state is a little bit different, but you know, it starts with you know, issuing a demand letter, starting to file the paperwork and go down that process. But ultimately you know, if you have to go the whole way, there will be an auction style sale where you as the lender say, I am selling the property to the highest bidder. If there is someone there at that auction to bid on that property, then the house sells and you get paid in full.
And that's you always hear trustee sale or the courthouse steps, like that's what that is.
Yeah, trustee sale or sheriff sale, depending on whether it's a deed of trust or a mortgage state. But you have to go through that unless there's some negotiation with the borrower before that.
You made an interesting comment earlier. You said just because a borrower defaults doesn't mean you lose money. You can still make profit with a borrower defaulting. Talk to me about that.
Yeah, the defaults that we have experienced really are a cash flow, a liquidity situation for the borrower. And we do a lot of value add lending, you know, where the property needs to be improved. And so what will happen is that the borrower will get into the project and maybe they have multiple, but they're not able to finish the project. So it kind of sits static. And then their liquidity gets further depleted, making the debt service on the loan. And then ultimately the project's not getting completed. So I have seen situations, and I've seen about everything, but where, you know, the borrower just says, hey, I have to walk away from this. Then the lender will take the asset, who's got cash flow, who can actually finish the construction, put it on the market. And I've seen folks earn their interest back and then some beyond that. I'm not saying that you won't lose money.
And it's not the investment strategy. Like a default is not good even if you're making more profit, because I think the reason a lot of our investors are doing this is the passivity of it. And a default is anything but passive.
Yeah, you know, it's a part of lending money, as I mentioned, so you have to kind of factor that into your investment returns, but it's not the end of the world. There is a legal path to go through. You know, we know the borrower, we know the lender, we're going to be the go-between, and we're going to work hard to mitigate the situation. And you just have to stick in, and just because you catch one of those, you just, after it's over, whatever the end solution is, we'll find that best end solution. You just got to get right back on the horse and lend again.
And I think that also speaks to us only lending in good locations and neighborhoods, and only doing first trust deeds.
Yeah, well, the worst case scenario when you're the first lien lender is that you end up with the asset.
Is your loan amount a dollar amount, you're okay buying the property? Because if that's the case, then that's your risk. Your risk is I'm going to own this property because I've lent this first trust deed, and you know.
And in collateral-based underwriting, that's really the last question that we're asking ourselves. Am I okay owning that property for the loan amount and the loan structure? And if the answer to that is yes, well, then you're full bore ahead because, hey, I'd love to own that asset.
Yeah, totally. Oh, talk to me a little bit about loan to values. Like, what are you looking for? And does that change on scenario, whether that's new construction or fix and flip or a long-term hold?
Yeah, loan to value is probably the most important metric to quantify when it comes to risk. So the lower the loan to value, the lower the risk. The higher the loan to value, the higher the risk. So it does change by scenario. So certainly if we're doing a fix and flip, right, we're going to be, you know, high, but not too high on the acquisition of the property. We will lend the construction money. Of course, that's all in reimbursement style. On that front, we'll go up to 70% of the after construction value. When it comes to bridge loans, so no intent to improve, we'll go up to 80% of the acquisition. And on new construction, really, we want the borrower to own the land clear. That's really their pledge, and that's where we can put the lien position. And then they start the improvements, foundation and so on before they go vertical. And then we're divvying out the loan just in safe draws. The overriding factor is that the loan amount is always less than the value of the property, right? That's what needs to happen.
Significantly less, because if you're at a 5 or 10%, spread, it's not going to cover your costs if there is a foreclosure or you do have to take ownership of the property.
A good way to quantify that is with the mortgage fund. Our aggregate loan to value has always been under 65%.
Yeah, absolutely.
That's a very safe place to be.
Yeah.
It's the borrower's equity who's at risk,
Totally.
even in a falling market.
Yeah. What are we up to this weekend? Where are we right now?
This is a fabulous location. We're out in the desert having a great time.
Yeah.
Just excited about pickleball this afternoon. We got a tournament coming up. Got a lot of folks here from Marshall Reddick that are on our team, both from California and Texas. And it's just always good to come together, building relationships as a team and having a great time doing it.
Yeah. I think for me, that's probably one of the most important things of pushing us forward all these years is that we have that synergy and camaraderie. And I think these weekends kind of allow you to recharge your batteries and just get really good ideas, brainstorming conversations and innovative thinking that maybe in the office or on the day-to-day is hard to grasp.
Well, you got to really like the people that you work with.
Yeah.
And the day-to-day gets hectic sometimes,
Yeah.
and you even forget to say hello or how's your day going.
Yeah.
So coming out here for a couple of days,
slow down,
and eating together, communing, having a good time. It goes a long way for that relationship building.
I think one of the biggest things for me over the years has been our skill set of hiring people better. I think in the early days, we, like anything, if you haven't hired a lot of people, you obviously can't be good at it, whether that's, riding a bike or, shooting clay. You have to do it to get good at it. But I think we have really honed in our skill set of identifying awesome people that are very talented. And I feel like the overall level of the team has risen significantly. And I think that's been a huge part of our growth and a huge part of the, mortgage fund and the lenders getting great returns is the quality of people on the team.
Yeah, hiring is and maintaining good talent is very difficult thing to do.
Recruiting is only half of it, right?
Yeah, and as you said though, reps. You need a lot of reps.
Yeah.
Getting into those interviews, understanding who they are, getting them
type.
to understand who you are, what the culture is at the office, and it's kind of like a work hard to play hard kind of mentality. And we have just the luxury of working with real estate investors and improving their lives financially. Yeah. It's just a great thing. So it's very rewarding, but I definitely think that we have an excellent team. Yeah. I think we're a great place to work. Yep. And you got to come in and just
enjoy
get after it.
Yeah.
You got to get after it.
Yeah. Anything else? Any questions for me or, I'm curious.
Ross, how did you get so good at pickleball? How did that happen?
Well, unfortunately, it's not because I play a lot, because I would love to play way more than I do. I don't know. Ironically, we started in college, we started a retail company, which was really fun, life experience in a whole nother world. This was 20 years ago. And we had a big warehouse in Westside Costa Mesa, and it had a pickleball court in it.
Well, there you go.
And that was probably...
Before pickleball was important?
2003. Well, I don't know if I'd say pickleball wasn't important, but yeah, it definitely was not as mainstream. Maybe 2003, 2004 is when we really started getting into it. A couple buddies of mine grew up in Pacific Northwest, so Seattle, Gig Harbor, and it was big out there when they were kids. They actually had a court growing up at their house.
I see.
And so we started playing early, I guess, but yeah.
What about, the day-to-day and finding enough time in the day to do all that is required of your role? I mean, as a leader of Marshall Reddick and having a family and trying to grow the team, and the office is out of the state of California.
Yeah.
And I think we're 150, 160 staff
Yeah.
now.
Daily
How do you
hiring.
prioritize? How do you make it through every day?
I used to think you needed to do everything perfect. And now I realize you need to do everything well. And part of doing everything well rather than perfect is trusting the people around you. And I think which has been a huge learning experience for me, as you and I both struggle with, we do things ourselves. If you want to get it done, do it yourself. And I realized probably the last 3 or 4 years, when we started getting over 100 team members, is really when I started to break. And I realized at that point, like, I have one of two choices, right? We got to curb growth, and I can continue to do everything. Or if we want to continue to grow, I have to figure out what to give away. And so, I mean,
Delegation.
Yeah, delegation. I mean, you're a great example of it, right? Like, we used to talk daily about everything, and I'd ask you a million questions 24/7. And, now we talk more weekly, and it's more like you updating me and, here are 3 options, and I recommend this option, and these are the pros and cons, and, what do we do? And, before it was like, I need to meet with the vendor. I need to look at the software. I need to, interview the team member. And so I think having the right people around you that you can trust.
Leaders?
Yeah, leaders. And leaders are so hard to find. Managers are so easy to hire. Leaders are impossible. Nothing's impossible, but it's a lot of work, and if you can find those leaders and just give them what they need, time, resources, like compensation packages, like you gotta incentivize your leaders to really buy in and own their territory. And I think that's probably been the biggest difference in the last 3 years versus the first 15 years.
Mm-hmm. What's the end game for Marshall Reddick? I mean, how much is enough? Where you want to go with this? What's the vision today?
Yeah. So we've actually been having a lot of conversations about that internally, and the early days was market share. The early days was growth, and we were really focusing on just top line revenue and opening offices and bodies. And I think that was important. I think scale has really helped us tremendously with the brokerage and property management and, the mortgage fund. I mean, part of the reason we didn't start with a mortgage fund is we didn't have any money. We were broke. We were kids, and
lots changed over the last 20 years.
I still like to think I'm a kid. I try. I stretch every day. Yeah. That's actually the truth. But I think for us now, we want to grow well, meaning we don't want to force growth. We don't want to grow for the sake of growth. We want to work with great clients. In the early days, we would work with all clients, and just working with someone with money that's a jerk is not fun, and it really reduces staff morale. And there are just a lot of great people out there that just build you up, and there are also a lot of really horrible people out there that tear you down. And I think, vision for Marshall Reddick is just continue to grow organically, bring on good people and do good work and just see where it takes us. But I think we have some really crazy talented people that are very ambitious. And so I think growth is inevitable. And so my new focus is just growing well, whether that's better processes and systems, better documentation, better software, more software integration, just really being that guy behind the scenes, following these amazing leaders and picking up all the pieces as you guys just demolish the world in front of you. Mm-hmm. I think, and being in that supporting role for me, I think is where I've really, I think that's made me the most happy. It's so cool to see the team buying homes and getting married and having kids and buying investment properties. And, we got multiple team members with over 7 figures in the mortgage fund. That blows my mind. Yeah. I could have a team member be a multimillionaire, where in the early days I was like, if I could just have $1 million, my life would be so much easier. And all I figured out is it's more complicated.
That's the biggest sales tool that I have with the mortgage fund and the capital raise, to be able to say that 10% of the capital stack has been invested by
Just team
Marshall Reddick
members.
team members.
Yeah.
And again, with 75 million today, that's 7.5 million across those
Totally.
that have taken the plunge to invest with us. That's
Yeah.
so
And
fantastic.
that's cool for me to see too, because, you know, it's like, especially in our industry, right? We're a very flashy industry of big houses and cars and watches and suits and all that. And I think sometimes we forget about, you know, budgeting and growing your net worth and investing because we want to look successful. And I think we've done a great job within the culture of Marshall Reddick of like, your balance sheet is really what makes you successful, and your, you know, your individual P&L as a person. Like we
Totally.
are the corporation of Pat Prunty, right? The corporation of Ross Nelson, and like how we lead our family and how we are examples of our friends in the community. Like I think that's just so important.
Yeah. Can you give me the Marshall Reddick elevator pitch?
You asked that because I hound everyone in the company. I think that as a leader, you need everyone to be on the drop of a dime, understanding the mission, vision, and values of a company, and that is so important to me, and that is drilled into everybody, whether you're, you know, HR or a loan processor or a loan officer or a realtor or a property manager or maintenance manager. I think the elevator pitch is so important for any company because that's really the glue that holds everyone together. Like, what do we do? How do we make money? What is the service we provide? So that's why you're asking me that, and I'm happy to give you the elevator
I was going to
pitch.
say, do you know
I
it?
know. I'm dragging this on. We always like to say, you know, what do you do for work, or, you know, what do you know, do for your career? And you always start with, well, I do real estate. And if the person you're talking to cares, they'll dig into it more, because saying you do real estate is the broadest statement ever. And if they don't care, they won't ask you anything else. But assuming they say, oh, that's interesting. So what do you do within real estate? What I say is, we're a residential and multifamily firm that has 4 different divisions. The first being brokerage. We help people buy and sell properties. The second being property management. So we help people with maintenance, leasing, renovations, rent collections, everything from A to Z. The third being hard money loans. So we work with borrowers all over the country, whether that's fix and flips, new constructions, long-term rental holds. And the fourth is mortgage investing. So some of our clients are buying real estate and collecting rent checks, and other clients are investing in mortgages and collecting mortgage payments.
Well done.
Yeah. So that's what we do, and that's our elevator pitch.
Okay, I got one last question for you.
Yeah.
What is the fastest growing division at Marshall Reddick? You mentioned brokerage, property management, and private lending. Those are being the core businesses. Which one is the fastest growing currently?
Oh man. Okay, that is a very complex question.
I know it is.
So we're in a very unique market right now with brokerage. So as we know, the home affordability rate has, you know, dropped tremendously. So from a brokerage standpoint, it's been really difficult to grow sales on a per agent basis. One thing that's been really cool about brokerage is we've been bringing on some incredible agents. So brokerage has been growing a ton. This will actually, you know, which is crazy that I can say this, but like 2025 will be our best year in the history of the company.
And is that revenue, profit, or both?
Both, fortunately. Yeah. Actually, so both top line revenue, bottom line profit, as well as percentage of profit margin. I think a big reason for that was our accounting. I think when we brought in Sage Intact and created, you know, financial projections, budgets, lots of financial reporting, both based on an office level, on a division level. I think that was really so insightful to me, because in the early days, I viewed the business as a whole. There was no private lending revenue or property management revenue or profit margin for the mortgage fund and then profit margin for direct. It was all just thrown in a giant pot and stirred around. And it's like, okay, if we made more money than we spent this month, then it was a great month. Mm-hmm. And you helped me, honestly, you helped me a tremendous amount with that. I mean, before you were our fund manager and director of private lending, you were our controller. And so transitioning you out of that controlling role to private lending in the early days was awesome and great, but there was definitely a void there for a couple years, I think, until we had our current leaders in accounting. So I think that was probably the biggest thing that has helped us have this be our best financial year. But to your original question, I think that private lending and the mortgage fund have the largest potential for growth in the next 3 years because the new software that we're implementing and becoming an audited REIT, we can now work with insurance companies, family offices, university endowments. And so we're having great conversations right now, which is so much different, right? Because currently that $75, $80 million in the fund and that $1 to $2 million of additional capital each month is from people, just accredited investors that are putting in, 50, 100 grand, 500 grand, $1 million bucks. And that's great. And that's awesome. But, as we move to this next chapter and we have the ability to have institutional capital, these have $20, $25 million minimums for one check and one, capital partner. And so I think there's the highest potential for future growth in that division and department, which is why we're investing so much in software and process and systems right now. But on the flip side, property management has been incredible as well. I think we've created a lot of great partnerships with build for rent companies, private equity groups, high net worth individuals for apartment buildings. And so, man, it's just so humbling, to be honest with you. So I don't know. I think the leader of each division is going to decide.
Yeah. Well, what I think I heard initially, though, is currently it's the real estate brokerage, and the sort of the back end of that question is, how is that given the nature of interest rates that started to spike in 2022, and it's been it's kind of the new norm now.
Yeah.
So I think there's two questions there: is how are you able to grow the brokerage given the interest rates, and where are interest rates headed?
Man, those are two very loaded questions I could talk about for days.
Yeah, we'll keep them. We'll keep them short.
Yeah. So I think with the brokerage, one thing that's been really unique is like for newer agents, younger agents, not necessarily age, but experience.
Their career.
Yep, exactly. They have a really clear learning path. So because of property management, we're leasing, 200 plus units a month. And we also have, coming up on 4,000 units under management. And what's unique about that is they're constantly working with landlords. And so that gives them a step into real estate where, the traditional real estate model with XYZ brokerage,
Here's your phone book.
Yeah, exactly. You're not making money for the first year or two. So you really have to have a spouse or a parent or a second job, to kind of make that 1 to 2 years of no income transition. And it's really discouraging. It's hard. It's a long road.
So the agent starts in property management as a leasing agent before they transition to the brokerage?
It really depends on the agent. But yes, that's an awesome path to go. The other way is co-agenting. We have some really high performing agents that do a lot of transactions. And so kind of coming under their wing and doing, the appraisals, the inspections, working with the transaction coordinator and
cutting your teeth.
Yeah, just, getting in there and doing deals next to really high performers. And I think a lot of it too is we're in the office. We're in the office every day. We're either in the office or at properties or with clients. And I think that's a really unique dynamic in our industry where I feel like there's a lot of lone wolves that are kind of doing their own thing and working out of their house or coffee shops or not working at all and just going to happy hours.
Yeah, collaboration.
Totally. And so when you're in this environment with, 3 or 4 other agents that are really high performers on the phones and you're overhearing those and sitting in conference rooms and speaking to clients, like I think that makes your rate of learning just so much shorter. Like the learning curve goes from 2 years to like 6 to 12 months, kind of depending on the time and effort you put in. And so I think that's been a big part of us bringing on great agents, which in turn has been a big part of brokerage growing.
Mm-hmm. Okay, so let's not forget, where are the rates headed?
So we're not going to talk about whether or not I agree or disagree. I do think there will be a couple small rate drops. When I'm looking at like U3 and U6 unemployment rates, and I'm looking at mortgage default rates and various economic factors, in my opinion, I think where rates are at are fine. It's painful. I mean, it's
historically, the 6-7% is a fantastic
it's totally
interest
normal. And the problem is we just have a massive hangover right now. Like, we have been drinking the Kool-Aid and way too low of interest rates for way too long. And people have gotten used to overspending and not being resourceful. And because of that, here we are. Yeah. And you can't work through that in the course of a year or two at the quantity of money we have spent and divvied out to so many people. And so I do think, though, to answer your question specifically, I do think we will see small rate drops, 10, 25 basis points. I don't know if it'll be every quarter, every 6 months, but I do think there will be 100 basis point drop over the next 18 to 24 months. And I think it'll be very slow and very controlled, which is good. But I don't have a problem with where interest rates are at right now. I think they're fine. And yeah, there are businesses and real estate investors that have over leveraged and they're hurting. I mean, they are feeling it. Like, if you bought multifamily, in 21 and 22 on a floating rate debt, or
if you had office pre-2020.
Totally. I mean, it's going to hurt, and there's going to be a transfer of wealth, but that's business, So
are we going to see 2.5% 30-year fix again?
I mean, gosh, I hope not. I pray not. But I mean, I don't, when the government's involved, anything is possible, and you have little to no say. So I really hope that doesn't occur again. I think, I'm personally grateful it happened when it did, just because, of all the opportunity we got with refinancing properties we owned from years prior, and the growth that we saw in the business.
Putting that primary on that super low debt.
Oh my gosh.
Never going to sell it. Never going to sell it.
I know. I mean, so from a selfish standpoint, I'm personally very grateful that we went through that, because it really benefited us, and I think will have been a pivotal turning point in our lives that, financially it changed our lives forever. But I also hope in the same breath that it doesn't happen again. So.
Well, Ross, thank you so much for this interview.
Pat,
this was fantastic.
I love you, bro. You are
always
the man.
love getting together, and I think
we never do it enough.
It is
so awesome.
Showed the public and the crowd,
I know.
A little bit about Marshall Reddick
fans
and all good. So
cool.
Appreciate you.
Yeah, you too.